In this video, we'll break down the truth about ESG investing, what it is, why it gained traction, and where it's falling short. We'll look at the rise, the backlash, the greenwashing, and the ratings that doesn't always add up. Most importantly, we'll explore whether ESG still matters and what smart investors should focus on instead. Let's get into it. For investors, ESG is a framework to evaluate companies beyond just profits. It stands for environmental, social, and governance, and it helps assess how well a business manages long term risks and responsibilities. The environmental factor looks at a company's impact on the planet, including carbon emissions, climate risk, renewable energy, and waste. The social factor considers how a company treats people, from labor conditions and diversity to community engagement and human rights. And governance looks at how the company is run, including board independence, executive pay, shareholder rights, and transparency. By considering these non financial factors, ESG investing aims to identify companies that are better positioned for sustainable long term performance. ESG investing emerged as a response to growing concerns, climate change, social inequality, and corporate scandals. Investors wanted more than just returns. They needed a way to manage long term risk and hold companies accountable. The idea was simple. If businesses consider environmental, social, and governance factors, they are more likely to be sustainable and transparent. ESG promised better risk management, ethical investing, and a more responsible approach to long term value. ESG came with big promises, not just doing good, but doing well. Investors believed it could deliver stronger returns, reduce long term risks, and align portfolios with purpose. It was also seen as a path to earning trust, building resilient brands, and future proofing businesses. For many, ESG looked like a smarter, safer way to invest. ESG went from niche to mainstream in just a few years. Trillions of dollars poured into ESG labeled assets, and one in every three investment dollars considered ESG factors. Large firms adopted ESG strategies. Companies rolled out sustainability reports, and green finance surged. For a time, ESG became the default setting in modern investing. At its peak, ESG looked unstoppable. Trillions in assets, corporate buy in, and global momentum. But that momentum didn't last. Investors began asking tough questions. Were ESG labeled funds really delivering better outcomes or just better marketing? Criticism followed. The ratings were inconsistent, the goals were unclear, and ESG quickly became a political flashpoint. And at the center of it all was one issue that wouldn't go away: greenwashing. Here's where ESG started to lose credibility. Greenwashing. It's when companies exaggerate or mislead, claiming to be responsible or sustainable without backing it up with real action. Think fossil fuel firms promoting net zero goals while expanding oil production, or fashion brands selling eco collections made in sweatshops. It creates false ESG credentials, breaks investor trust, and makes it harder to spot companies that are actually doing the work. In the end, greenwashing doesn't just damage reputations, it undermines the entire purpose of ESG investing. Here's another problem: one company, three ESG scores: high, low, and somewhere in the middle. Why? Different rating models, different priorities, and often incomplete data. There's no global standard, so the same company can look great or terrible depending on who's rating it. That makes it hard for investors to know what's real and what's just noise. For all the hype, ESG didn't always deliver better returns. Many funds underperformed, hit by inflation, rising rates, and heavy exposure to tech. Meanwhile, energy stocks surged, and ESG often missed them. Some funds were even ESG in name only, holding the same old portfolios. We've seen the hype and the cracks, from greenwashing and inconsistent ratings to underwhelming performance. But that doesn't mean ESG is broken beyond repair. The idea still matters. Investors do care about long term risk, responsibility, and impact. The problem isn't the why, it's the how. With clearer standards, better data, and sharper focus, ESG can still evolve into a more useful, more credible tool. It's not about scrapping the concept, it's about doing it properly. At this point, it's clear ESG as a label isn't enough. Don't get caught up in branding, buzzwords, or glossy reports. Focus on what really matters: solid data, clear metrics, and outcomes that align with long term value. ESG isn't a box to tick, it's a mindset for smarter investing. After all the hype, backlash, and confusion, one thing is clear: ESG was never just a trend. It was a signal that investors wanted something more. We've learned a lot. We've learned that labels can mislead, ratings can contradict, and performance doesn't always align with purpose. We've seen how greenwashing erodes trust, how vague standards cause confusion, and how the ESG label alone doesn't guarantee anything. But we've also learned that the core idea behind ESG still matters, and that responsible long term investing is more relevant than ever. What happens next? We shift the focus from buzzwords to better data, from scores to substance, from image to impact. We don't need to throw ESG away, we need to rebuild it with clarity, accountability, and discipline. Because ESG doesn't need to be perfect, it just needs to grow up and get real. Thanks for watching. Keep learning with Kash Concepts, where we make finance simple, clear, and practical. Don't forget to like, comment, and subscribe. And follow us for more videos that make finance easy.